Tonight at 8 p.m. Eastern Time, a geopolitical ultimatum expires. But looking at the broader stock market today, you see a global financial system sleepwalking toward a cliff. Current equity levels are being artificially propped up. Algorithmic trading systems are aggressively buying on the assumption that regional intermediaries will secure a temporary 45-day ceasefire before the clock runs out. The diplomatic reality on the ground is entirely different. Negotiations between the U.S. and Iran have hit a profound impasse, making any reconciliation before the deadline mathematically improbable. The peace dividend that markets have traded on for the last decade is over. When that deadline hits zero, severe kinetic military escalation is guaranteed. To understand exactly what happens to your capital next, we have to map the mechanical chain reaction. We will trace how a localized maritime blockade forces global central bank paralysis, and detail exactly how institutional balance sheets must be restructured to survive the fallout. Capital preservation right now requires looking past the foreign policy headlines. This is a severe structural macroeconomic shock, and it instantly rewrites the rules of risk arbitrage and institutional investing. This diagram illustrates why the peace talks are completely gridlocked. We have two competing frameworks, a US-backed 15-point plan and an Iranian 10-point counterproposal, that operate in mutually exclusive realities. The American framework demands absolute capitulation. It requires the complete dismantling of all Iranian nuclear facilities and the surrender of enriched uranium to international inspectors, in exchange for a brief 45-day pause in hostilities. Tehran categorically rejects any temporary truce. Their counterproposal demands a guaranteed permanent end to the war, the immediate lifting of all Western sanctions, and formal war reparations. But the deal-breaker lies here. Iran is demanding a staggering $2 million transit fee for every single commercial vessel passing through the Strait of Hormuz, intending to use the global energy trade to fund its own domestic reconstruction. This specific demand guarantees the deadline will fail. It converts a standard military blockade into sovereign commercial extortion. The U.S. administration relies heavily on the doctrine of global free trade and cannot politically or economically accept an Iranian tax on global sugar. So, at 8:01 p.m., diplomacy ends. The immediate physical consequence will be heavy U.S. bunker-busting munitions targeting Iranian military compounds and covert research complexes. Iran will respond asymmetrically. They will retaliate by targeting the centralized power grids and critical desalination plants of U.S. allies across the Gulf Cooperation Council, creating an instant regional humanitarian crisis. This map highlights the most critical vulnerability in the global economy. As missiles fly, the Strait of Hormuz closes indefinitely. This single choke point handles 20% of the world's daily oil consumption, roughly 11 million barrels a day, along with 20% of global liquefied natural gas trade. This localized diplomatic breakdown instantly severs the world's primary energy artery. It creates a massive physical supply deficit that no release from the Strategic Petroleum Reserve has the volume to offset. This chart tracks Brent crude, which is currently volatile but contained near $110 a barrel. The moment the bombing commences, this price violently gaps higher, projected to breach the $130 threshold within 48 hours. If Iran successfully strikes the energy infrastructure of those Gulf allies, we are looking at parabolic spikes pushing crude toward $150 a barrel. There is a persistent narrative that American energy dominance will insulate the U.S. domestic market from the shock. That is mathematically false. Because oil and natural gas are priced on global commodity exchanges, the sudden restriction of Middle Eastern supply forces desperate international purchasers to bid up alternative American crude. We directly import the global price shock. For the domestic consumer, that translates instantly to the gas pump, pushing U.S. national averages well past $4.12 per gallon. And that energy inflation immediately bleeds into corporate operating expenditures. U.S. jet fuel prices have already skyrocketed 95%, forcing logistics giants like Amazon, FedEx, and UPS to institute heavy fuel surcharges just to protect their bottom line. The geopolitical standoff has breached the corporate balance sheet. This energy spike acts as a massive, inescapable regressive tax that violently compresses operating margins across the entire supply chain. Prior to this escalation, markets were confidently pricing in a soft landing, engineered by steady interest rate cuts. That consensus is dead. The Federal Reserve is walking into a severe stagflationary trap.
They face a rapidly slowing, energy-constrained economy, but they cannot cut interest rates to stimulate it without pouring gasoline on a supply-driven inflation fire. Looking at this timeline of expected monetary easing, major Wall Street institutions are aggressively erasing their dovish forecasts. JPMorgan has adopted the most hawkish stance, officially projecting 0 rate cuts for the entirety of 2026. Looking further out, they're forecasting a 25 basis point interest rate hike in the third quarter of 2027 to combat sticky inflation. CEO Jamie Dimon has explicitly warned clients that these surging commodity costs risk triggering a severe 1970s-style recessionary spiral. A higher-for-longer rate environment exerts immense pressure across the broader economy. With 30-year fixed mortgage rates locked above 6%, housing market mobility stalls, which severely depresses consumer discretionary spending. Monetary policy is completely paralyzed. Corporate treasurers are now operating without the safety net of imminent rate cuts, making traditional long-duration debt highly toxic. Many traders are assuming a swift recovery, similar to the 2003 Iraq War or the brief 2025 nuclear site strikes. That assumption ignores the structural reality of this specific conflict. This table of historical market precedents reveals a consistent rule. The severity of an equity drawdown correlates directly with the physical withholding of oil, not just the kinetic violence. During the 1973 Arab oil embargo, a severe physical supply shock caused a 16.1% peak drawdown in the S&P 500, followed by a grueling 6-year recovery timeline. That was a period defined by deeply entrenched scarcity and inflation that the Federal Reserve struggled to contain. Compare that to the 1990 Gulf War. The market suffered an initial 15.9% drop, but recovered in just 260 days once a swift, decisive military victory restored the physical flow of energy. Today's blockade aligns structurally with 1973. If the strait remains closed, quantitative models project a sharp 10 to 15% correction across broad equities. This drop is driven by a painful dual mechanism. Surging input costs violently compress corporate margins, right as elevated long-term interest rates force valuation multiples to contract. History dictates an unyielding rule. Global equity markets will not establish a durable bottom until there is verifiable evidence that commercial transit through the Strait of Hormuz has been fully restored. The traditional 60-40 portfolio is built for peace and stable inflation. Under the intense pressure of wartime stagflation, equities and long-duration bonds will correlate downward together, causing catastrophic stress. This is the corporate survival playbook. To protect capital over the next 12 to 18 months, we must execute a rigorous, three-pronged repositioning strategy. First, the fixed income pivot. Duration risk is currently the most toxic element in finance. Investors must severely underweight long-duration sovereign debt to avoid heavy capital losses as yields rise. Instead, aggressively overweight short-duration quality bonds, specifically in the 1 to 3 year maturity range. This locks in elevated yields while effectively eliminating duration risk. Next, the equity pivot requires a strict defensive barbell strategy. You must trim exposure to broad capitalization-weighted indices that are heavily reliant on vulnerable consumer discretionary spending. The first side of the barbell aggressively overweights aerospace, defense contractors, and domestic energy producers, sectors that directly monetize the conflict through massive margin expansion and government contracts. The second side maintains exposure to megacap, monopolistic AI infrastructure. These technology firms possess the massive cash reserves necessary to operate and grow independently of Middle Eastern geopolitics. Finally, foreign exchange and alternatives. Severe capital flight demands long positions in the ultimate safe havens, the US dollar, the Swiss franc, and gold, which is exhibiting tremendous structural strength past $4,650 an ounce. Conversely, you must actively short or hedge the Japanese yen. It is structurally breaking down as a traditional safe haven because the country's economy is entirely reliant on imported energy. Beyond financial allocations, corporate entities face immediate operational threats. Finance leaders must mandate cyber hardening today, enforcing multi-factor authentication and verified endpoint detection to defend against asymmetric ransomware attacks targeting critical infrastructure. The window for passive observation permanently closes at 8 p.m. tonight. Surviving this macro shock depends entirely on abandoning legacy assumptions and executing this inflation-hardened transition immediately.